coming in from the ABC. Economic recovery will be unpredictable and uneven, RBA warns as it models a 50% property price fall. We can see the key points in this article is the RBA's assistant governor says Australia's economic recovery from the Cerveza sickness recession will be unpredictable and uneven. Non-performing loans are expected to continue to rise as falling incomes make it hard for households to meet repayments. I think that's pretty straightforward and predictable. The RBA says the likelihood of a major bank failing is very low, but there are vulnerabilities. So there are warnings there. So more Australians could go into negative equity, where the value of their property falls below the outstanding balance on their mortgage if the pandemic-led recession leads to a big fall in house prices, according to the Reserve Bank of Australia. Well, I can tell you, ladies and gentlemen, that a lot of people already are in negative equity, especially those who have bought in the last 6 to 8 years in Brisbane and Perth and Darwin. They are in negative equity, especially the first home buyers who had very minimal deposit. A lot of our clients have tried to refinance or look at selling their properties only to find out that the values of their homes are not just fallen from what they bought it for, but have now fallen below what they owe. And in a way, these people are now kind of mortgage prisoners, suffering that negative equity. So there is a big problem out there already. In a speech about major risks to Australia's financial stability on Tuesday evening, RBA Assistant Governor Michelle Bullock warned more businesses would go under and this would have a negative impact on bank balance sheets. Ms. Bullock said the economic recovery from the recession would be unpredictable and uneven. There will be rising business insolvencies and problems for some households in servicing their debts, she said. The recession has raised the possibility some households will be unable to meet their repayments because their incomes have fallen. Well, that's the other thing is when you look at the unemployment rate, whether you want to use the ABS or the Roy Morgan data, we know there's 1.6 million people on Job Seeker and almost 4 million people on Job Keeper. That is a large portion of our workforce right there. This would see the banks face an increase in non-performing loans, Ms. Bullock said. She warned that while the share of loans currently in negative equity was low, this could change if there was a substantial fall in house prices. With population growth forecast to remain weak for the next year at least, it is possible the housing market could further weaken, especially across major capital cities. Price falls could be exacerbated by housing investors who, seeing vacancy rates rising and rents falling, decide to sell, Ms. Bullock said. And that is starting to happen in a very small way. I expect that to increase as we move into 2021. More households could face difficult circumstances. While households' cash flow has been underpinned by government income support policies, loan repayment deferrals and low interest rates, and some Australians have been saying and are saving and paying down their debt or building deposits. Many others are vulnerable. And that is true. We have seen savings rates pick up to just under 20% from about 6 to 8%. So definitely there's been an increase in saving. Also, we've seen credit card debt go down. However, we've seen other debts go up. And that's a combination of people taking funds out of their offset account or out of their redraw account on their home loans, so their balances have drawn up, or even just the deferrals. So interest has been capitalising. So there's that to read into. Not all households will have been able to increase saving and will find themselves in difficult circumstances, Ms. Bullock said. At the peak in June, about 8% of housing loans were on deferred payments. Many of these deferrals ended in September and October and payments have recommenced, she said. Well, yes, some have. Some aren't making their full repayments. Some are making something, but many others aren't. And a lot of those customers, 8% of all loans deferred, a large percentage of those are ghosting their banks, meaning the banks are trying to contact them and they're burying their head in the sand and not answering their phones or replying to the bank. So that's a big problem. There is still, however, a significant minority of households that are seeking to remain on deferred repayments. Many of these loans are higher risk in that they tend to have higher loan to valuation ratios and are held by people who work in industry particularly at risk from the current health crisis. A lot of first home buyers right there. Non-performing loans to households which had already risen over the past couple of years and therefore expected to continue to rise over the coming months. She said banks had increased their reserves for future losses. However, this position could change. The Reserve Bank carried out hypothetical modelling to show what could happen to banks' balance sheets if something unusual and unexpected happened. As an example, one scenario that would see a major bank's capital ratio fall below 6%, that is well into its capital conservation buffer, would be a fall in property prices of 50%, with GDP declining by 20% and unemployment rising to 20%, Ms. Bullock said. A downturn of this magnitude has not been observed since the Great Depression, and even then, capital ratios remain about prudential minimums. This confirms that the likelihood of a major bank failing is very low, but there are vulnerabilities. Well, that's interesting because Roy Morgan has unemployment just under 13%, about 12.5%, and if you have a look at nearly 4 million people on JobKeeper. When the trading insolvent moratorium ends at the end of this year, how many businesses are going to go under? Are those nearly 4 million job keepers going to get their jobs back, or are they going to end up on the unemployment queue? And could unemployment push up higher than what Roy Morgan's saying in the 12 to 13% range where we're currently at? I think that's a very likely scenario that unemployment does rise for some time. And in fact, I think first home buyers right now are being led to the slaughterhouse. They're the lambs being led to the slaughterhouse right now. We won't help first home buyers into the market if they haven't proven that they have saved at least a 10% deposit, excluding any of these government grants and incentives or inducements is what they should be called. But anyway, I think that or some people that I follow anyway, very intelligent people, believe that we've now got to a scenario where none of the debt can ever be paid back on any levels, and we're going to have some massive changes coming, and they're mostly going to hurt the middle class and the poor, and we'll see where that goes. Anyway, let's keep reading. Business failures to impact banks' balance sheets. Aside from the risk from households, small businesses have been hit particularly hard during the recession, with revenue falling in aggregate by close to 15% since March. In industries such as arts and recreation and accommodation and food services, the declines in sales have been even bigger, Ms. Bullock said. She said as stimulus measures were wound back, business failures would increase, and this would happen even as the economy started to recover. Survey evidence suggests that around a quarter of small businesses that are currently receiving income support would close if support were removed now and trading conditions had not improved, she said. While not all business failures will result in losses for the banks, it will have an impact on banks' balance sheets. The area of particular concern is commercial property. The retail vacancies on the rise. This has accelerated with the onset of the pandemic, particularly in CBD retail, Ms. Bullock said. And don't forget, a lot of these small businesses also have mortgages and maybe investment properties. And if they go under, what happens to those debts? That's also not being taken into account. She said there was uncertainty about prospects for rental demand for CBD office property, particularly in Sydney and Melbourne. In both cities, there is substantial new supply coming onto the market, and vacancy rates have already started to rise, she said. Well, this is the interesting thing, is in our industry, in the mortgage broking industry, we are seeing more and more brokers going digital, having meetings with their clients using things like Zoom, Technology now have digitalised the whole process from application right through to doing identification, all the anti-money laundering stuff, right through to settlement now has become digitalised. And so people can work from home. People don't need to have those shop fronts or those office buildings, which reduces the costs for a lot of these businesses in our industry in particular. Commercial property prices could experience sharp falls in this environment, putting pressure on investors that have borrowed to invest in such property. While banks do not have a large direct exposure to commercial property, impairment rates are likely to rise. Ms. Bullock said there were also still big international risks that could spill over into Australia. High corporate debt in some countries, high sovereign debt in Europe, and low profitability of banks in some countries all pose a risk to financial stability, she said. And she's right. But don't just look at overseas, look in our own backyard. The current recession is likely to exacerbate these issues and potentially impact the financial system's ability to cushion the shock. Victorian drag on economy won't be so bad, RBA deputy says. Earlier in the day, Reserve Bank Deputy Governor Guy Debelle was more positive about Australia's recovery from the Cerveza sickness recession. Now, he has been slammed today for what he said, and we'll continue to read and you can see what he said, but he has been absolutely slammed today for his comments. Basically, everything he's saying or said, people are saying is untrue, but he's trying to jawbone the economy, jawbone people into going, oh, things are cool, let's go spend. And anyway. He told Senate budget estimates Australia's economy may have performed better than expected in the September quarter. Mr. Debelle said the RBA was releasing new forecasts next week, but his best guess was Victoria's extended lockdowns did not have as large an impact on the national economy as expected. Well, yeah, have a look at the fiscal and monetary support to the economy during that period. JobKeeper, JobSeeker, people taking out super, all the deferrals that we've had in rents and mortgages and you name it, the trading while insolvent moratorium, and then the government's inducements for first home buyers in particular, with government guarantees and the $25,000 home builder grant on top of state grants. So it's no surprising. However, the $25,000 grant ends in December. JobKeeper and JobSeeker has already started to be wound back and will continue to be wound back and will eventually end at the end of this year and at the end of March. The operating while insolvent moratorium that ends at the end of this year as well. The real pain. We haven't had the recession yet. The recession's still to come. The pain is yet to be felt. Let's see what the economy's like when we're in normal times without this big injection. It's like a drug addict that's coming off a high and they get another shot of whatever they take, and all of a sudden it's like, I feel better, but eventually they're going to come off that high as well. And do the government and do the central bank give the economy another dose of whatever we're high on at the moment, or do they say, all right, time to take the real medicine to get over this? And that's where the pain is gonna come. So, let's keep reading. That means Australia may not record 3 consecutive quarters of negative growth. It looks like the September quarter for the country probably recorded positive growth rather than negative, and that is the best we can tell, and this will be confirmed when we see the national accounts, Mr. Debelle said, or Dr. Debelle, sorry. The strength of the growth of the rest of the country was more than the drag from Victoria, and possibly the drag from Victoria was a little less than we had forecast in August. Australia's economy contracted by 0.3% in the March quarter and by 7% in the June quarter. There were 930 Australians considered officially unemployed, yet there's 1.6 million people on JobSeeker. Yeah. The official unemployment rate is 6.9%. The official underemployment rate is 11.4%. And the employment to population ratio is a low 60.3%. Yet there's 1.6 million people on JobSeeker. That's unemployment benefits. Once again, the ABS obviously don't speak to Centrelink. And that's why I look at the Roy Morgan data. The Roy Morgan data is a lot more accurate. This has all been hidden to paint over the cracks in the economy so that you out there think that everything's fine and that you'll go out and borrow some money and spend into the economy. And you know what? When things do go wrong, those that are holding the bags, those that are holding the high debt levels, they're the ones to go under first. In the federal budget, Treasury forecast that it would take about 5 years for the unemployment rate to fall to 5% and for inflation to be sitting comfortably within the 2 to 3% range. The RBA will announce its next interest rate decision this coming Tuesday. Well, interesting because we got the inflation numbers, and let's have a look at that. So this is the quarter on quarter, and you can see this is the quarterly rate. In the CPI numbers, it's different to inflation. And look at this. The numbers just came out. For the quarter, we've had CPI increase of 1.6%. That is a big jump. In fact, it's the biggest jump since the early 2000s. So you can see here, this is a quarterly jump right net here. This is a huge jump of 1.6%. And you can see that this is the highest it's been since the early 2000s. We've been warning about this. We've been warning about this, and we've been copping a lot of criticism about this. But, you know, it is what it is. So there you go, guys. What do you think of that? The RBA obviously sending out some mixed signals there on warnings of the economy. I think we still haven't even seen the recession yet. We haven't had the pain yet. Everything have been, the cracks have been covered over for now, but you know that is going to be pulled back as all this stimulus support ends and winds down, and we'll see where the economy is. You know, sometime in the, you know, definitely in the first quarter of next year, but really more in the second and third quarter of next year. We'll really get a good picture of where we are, and this is why we're just telling first home buyers to be very cautious right now, and actually anyone, just to be cautious right now. Patience has never killed anyone, folks. Having a little bit of patience, you know, and being a little bit prudent, you know, can't go astray. Don't let FOMO and the fear of missing out or the greed or whatever, don't let that control you. Use your brains. Be wise. Be patient. Opportunities will come. You don't want to be taking risks in such a time, in particular with debt, in a time where we've got all these headwinds for the economy. All these headwinds. So there you go, guys. Thanks for joining me on this episode, and I'll see you again on another episode of Finance Uncut.